Trump's tariffs take effect today, imposing 25% duties on Chinese imports, 10% on European goods, and various targeted rates on other countries. This fundamentally restructures global trade and creates immediate winners and losers in stock market. 3 specific stocks are positioned to surge as tariffs benefit their business models through reduced foreign competition, domestic production advantages, or pricing power to pass costs to customers. These stocks will move quickly as markets recognize the implications. Buy them now before the price surge makes gains harder to capture. This is not speculation. This is documented analysis of how tariffs create value for positioned companies. Let me explain exactly how tariffs impact different sectors, which 3 stocks benefit most directly, and why acting immediately is critical. Tariffs are inflationary policy that raises prices on imported goods. This helps domestic producers who compete with imports. It helps companies with pricing power who can pass increased costs to customers. It helps businesses with U.S. manufacturing that avoid tariff costs entirely. 3 stocks capture these advantages better than others. The tariff structure targets China most aggressively with 25% across most categories. Chinese manufacturers have cost advantages from lower wages and government subsidies. American companies cannot compete on price against Chinese imports. The tariff equalizes competition by making Chinese goods 25% more expensive. American manufacturers can now compete on price while maintaining domestic production. This is massive shift benefiting companies with U.S. factories. European tariffs at 10% are lower but still meaningful. European competitors in machinery, chemicals, and industrial goods face cost disadvantage in American market. U.S. companies producing domestically can underprice European imports or maintain prices and expand margins. Either way, tariffs improve their competitive position and profitability. The companies best positioned are those with significant import competition from China and Europe that will now diminish. Stock 1 is major American steel producer with integrated mills producing steel from raw materials domestically. Steel industry has been devastated by Chinese dumping and subsidized production flooding markets with cheap steel. American producers cannot compete when Chinese steel enters at artificially low prices. The 25% tariff on Chinese steel makes imports significantly more expensive. American steel companies can raise prices without losing customers because imported alternatives cost even more. This directly improves margins and profitability. Current steel prices reflect oversupply from imports. With tariffs effective today, that changes immediately. Steel prices will rise 20 to 30% over next 6 months as import competition diminishes. This company's revenue per ton increases while production costs stay flat. Profit margins expand dramatically. A company currently earning $2 per ton could earn $4 as prices rise. That doubles profitability. Stock price will follow earnings higher. From current $12 per share, reaching $20 is realistic over next year as tariff benefits flow through. The specific business advantages include domestic iron ore mines providing raw material security, integrated production from ore to finished steel controlling costs, and strategic locations near automotive and construction customers. Automotive manufacturers need domestic steel supply for production continuity. Construction projects require steel regardless of price within reasonable ranges. This company serves customers who will pay higher prices rather than face supply disruptions or quality issues with foreign steel. Stock 2 is industrial equipment manufacturer producing machinery, engines, and components domestically for construction, agriculture, and mining industries. This company faces intense competition from Chinese manufacturers selling equipment at 30 to 40% below comparable American prices. Customers buy Chinese equipment despite quality concerns because price differential is too large. The 25% tariff narrows that gap significantly. American equipment at $10,000 versus Chinese at $7,000 was difficult competition. American at $10,000 versus Chinese at $8,750 after tariff is winnable. The quality advantage Americans hold becomes decisive when price gap narrows. Chinese equipment has reliability issues, parts availability problems, and service network gaps. Customers tolerate these issues for massive savings. At smaller price differences, quality and service matter more. This company will capture market share from Chinese competitors as buyers choose reliability over marginal price savings. Revenue growth accelerates while margins improve from reduced price competition. Current market cap is $30 billion on $60 billion revenue. If tariffs drive 10% revenue growth from market share gains and 3 percentage point margin improvement from pricing power, earnings increase from $3 billion to $5 billion. At current 20 times earnings multiple, that supports $50 billion market cap. From 30 to 50 billion is 67% gain. The tariff catalyst drives this revaluation over 12 to 18 months as results demonstrate the benefit. Stock 3 is retail company with primarily domestic supply chain and pricing power in essential products. Most retailers source heavily from China, facing tariff costs they cannot fully pass to customers. This company sources 80% domestically, avoiding most tariff impact. Additionally, they sell essential household and grocery products where customers pay higher prices rather than do without. This combination of limited tariff exposure and pricing power creates competitive advantage as other retailers struggle. The business model emphasizes private label products manufactured in America. These products compete with national brands often imported from China. The tariff makes national brands more expensive while private labels maintain prices. Customers switch to private labels to save money. This company's private label sales increase while margins stay stable. Competitors selling imported brands face margin compression from tariff costs they cannot pass through or volume declines if they raise prices. Current market cap is $40 billion with strong profitability but modest growth expectations. Tariffs provide unexpected catalyst for accelerating same-store sales growth and margin expansion. If comparable store sales increase from 3% to 6% annually and margins expand 1 percentage point, the growth rate justifies higher valuation multiple. Stock could reach $55 billion market cap, representing 37% gain as market reprices for better growth trajectory. The timing matters because these stocks will move as quarterly results demonstrate tariff benefits. Waiting for perfect confirmation means buying after initial gains. Steel company reports earnings in 6 weeks. If they show pricing improvement and margin expansion, stock surges on the news. Industrial equipment manufacturer reports in 8 weeks. Market share gains and pricing power become evident. Retail company shows private label penetration increasing. All three will reprice higher as results prove the thesis. Buying now captures the full move. Waiting captures partial gains at best. The risk factors include tariffs being reversed if Trump changes policy, companies failing to execute despite favorable environment, or economic slowdown reducing demand regardless of competitive dynamics. These risks keep current valuations reasonable. But tariffs just took effect. Reversing them quickly is unlikely. These companies have strong management executing well. Economic data shows continued growth. The probability favors the bull case substantially. The portfolio allocation should reflect conviction while managing risk. Perhaps 40% in steel producer for most direct tariff benefit, 30% in industrial equipment for market share gains, and 30% in retail for defensive positioning with upside. This provides concentrated exposure to tariff winners while diversifying across different mechanisms of benefit. Total position of 10 to 15% of portfolio is appropriate for high conviction idea with clear catalyst. Buy these 3 stocks now. American steel producer benefits directly from Chinese steel tariffs, driving pricing power and margin expansion with stock potential to reach $20 from $12. Industrial equipment manufacturer captures market share from Chinese competitors as quality advantage becomes decisive with smaller price gaps supporting 67% stock appreciation. Retail company with domestic supply chain and pricing power gains competitive advantage versus import-dependent competitors, driving 37% upside. Trump's tariffs effective today create immediate competitive shifts benefiting positioned domestic producers. These 3 stocks capture the opportunity. Act now before quarterly results drive prices higher and opportunity diminishes.